All right, today we are digging into the latest earnings report from Baylin Technologies. And listen, this is more than just a numbers breakdown. It's really a classic business story about resilience, making some tough choices, and a pretty high-stakes strategy that could totally redefine the company's future. So let's get right into it. You know, behind every single stock ticker, there's always a story. And today, we're unpacking the story behind Baylin. They're a global wireless tech company, and they're at a really fascinating crossroads. I mean, they're facing some serious headwinds in a few areas, but at the same time, showing incredible strength in others. And that right there brings us to the central mystery of this whole report. It's a real head-scratcher, isn't it? How on earth does a company sell less stuff, but somehow become more profitable? At its core, that's the paradox we're going to try and crack today by looking at the hard numbers and the strategy behind them. So check this out. This slide just lays the contradiction out perfectly. On one hand, you've got total revenue for 2025 at $76.3 million. That's down almost 9% from the year before. But then on the other hand, their adjusted EBITDA, which is a key way to measure core profitability, it actually climbed to $6.1 million. That's up almost 13%. So what in the world is pulling these numbers in opposite directions? Well, the company's CEO, Leighton Carroll, gives us a massive clue right here. He points to disciplined execution. So this wasn't a year about chasing growth at any cost. Nope. It was all about controlling what they could in a really tough environment, with softer demand and customers pushing out orders. They just hunkered down and focused on efficiency, their product mix, and really beefing up their margins. So let's start with the good news, right? Where did that boost in profitability actually come from? Well, it turns out one part of the business wasn't just surviving, it was absolutely thriving. And here's the number that tells the story. This was the engine room of the entire company last year. The wireless infrastructure division, it posted a massive 32.5% year-over-year growth. Just think about that. This single division's performance was so strong, it managed to offset major weaknesses everywhere else in the business. And this wasn't just happening at home. They started gaining some serious international traction. In just a 30-day window in early 2026, they locked in orders from some of the biggest telecom names in Europe. We're talking Deutsche Telekom, Orange Group, SFR, and a Vodafone property. These are brand new customers, which just goes to show that their high-value products are really in demand across the globe. And see, this shows it wasn't just about selling more. It was about selling smarter. By really focusing on a higher value product mix, think their multi-beam and small cell antennas, they pushed their overall gross margin up to a super healthy 44.7%. That is a direct line from their strategy right to the bottom line. But of course, it wasn't all sunshine and rainbows. To get the full picture and understand that drop in revenue, we have to look at the other side of the coin, where the company faced some pretty significant challenges. A huge piece of the puzzle is right here. The company's order backlog, that's basically the value of purchase orders they haven't filled yet, it took a really steep dive. It fell by almost a third over the year. And that drop, it's a direct signal that new business was slowing down. And the main source of that slowdown was their SATCOM division. This part of the business, the one that deals with satellite communications, just faced a really tough market with less demand. This is where that headline revenue number really took its biggest hit. Okay, so you've got one division firing on all cylinders and another one that's really up against it. So what's the game plan? Well, Baylin is making two very big, very strategic moves to try and reshape its future. Their first big bet is a pivot towards the defense sector, right inside that SATCOM business. And as the CEO admits here, it is not an easy road. The sales cycles are super long, and the whole process can be, in his own words, maddening. It's really a game of patience and persistence. But, and this is a big but, that persistence is starting to pay off. They just landed a $2 million purchase order from a U.S. defense contractor. And this is the perfect example of the potential here. This is just the first phase of a program that could be worth over $10 million, and maybe even substantially higher, according to the company. Now, the second big bet is even more of a game changer, a pending acquisition of another company, Kaelus AB. This is a move that's designed to dramatically scale up their whole business, but it's not coming without some major risk and uncertainty, especially since the deal's closing's been delayed. And you really don't get much more high stakes than this. In their official filings, the CFO disclosed a material uncertainty relating to going concern. So what does that mean? It's scary sounding, but it's directly tied to the fact that they are still negotiating a new credit facility to actually fund the acquisition. It's a formal warning flag that shows just how critical closing this deal and getting the financing for it is to their entire plan moving forward. So when you put all these pieces together, the star performer, the struggling division, and these massive future plays, what's the final takeaway? What's the bottom line here? I think this slide just sums it up perfectly. On the pros side, fantastic margin expansion, that explosive growth in wireless, really good cost discipline, and they even reduced their net debt. But on the con side, that overall revenue decline, the weakness in SATCOM, the major risk from the delayed acquisition, and of course the drop in the order backlog, it is truly a mixed bag. And yet, let's circle all the way back to that theme of disciplined execution. Even with revenue falling, they managed to cut their net loss nearly in half, from $8.5 million down to $4.7 million. They also knocked down their net debt. This just proves that their focus on financial health and being efficient is having a very real, very tangible impact. And that leaves us with the million-dollar question for the future. We've seen a company that's proven it can execute with incredible discipline and manage its bottom line in a really tough environment. But is playing great defense going to be enough to weather these storms and build a powerful new foundation for future growth? Well, that's the story we'll all be watching unfold.